Welcome to Theo Trade. This is Don Kaufman. It's August 2nd, 2017. You are watching the Theo Night video. To begin with, S&P futures. Well, for the most part today, they're massively unchanged. Now, if you missed today's trading session, you kind of missed a little bit of Mr. Toad's wild ride as the S&P futures, they did stage a bit of a sell-off before rallying back. So we got a little bit of movement and we got a little bit of volume in the S&P futures, doing about 1.2, 1.3 million contracts today. But in a much larger sense, and we'll come back to Apple's earnings here in just a moment because I made a very, very bold call last night on Apple, but in a much larger sense, you know, I've been watching markets for just about 20 years now, and I grew up around traders and market makers. And, you know, over a lot of years, you know, you see all kinds of different conditions. The correlations that we look for in the marketplace, and when I'm talking about correlations, stuff like, for example, when the bonds rally, it's typically when the market's selling off. Or, for example, when the bonds rally, you know, the XLF would be selling off at that particular time. You know, bonds rally, financials sell off, market sells off, volatility rises. Okay, correlations are not only broken, they're smashed everywhere we look. And everywhere we look, this kind of scattered, sloppy trade is persisting on an intraday basis. You know, and I've had so many, not only just emails, I've had questions come in from other traders that have been in the industry even longer than I have, and we're all looking at the exact same thing, saying, you know, what's going on? And I'll give you a prime example of this. You know, I got a day today where Facebook is off. Okay, you know, Microsoft is off 0.4%. Again, Facebook's off about 0.3%. Apple's up. So let's just call that the odd man out because Apple's got earnings. Google is largely unchanged. Amazon is largely unchanged. Again, there's just this correlation breakdown every sector. You start to look at things like advanced decline line, the market. Okay, to say it's confused, I think, is an understatement. However, this reminds me, and it's reminiscent of a lot of different turning points that I've seen in the past where it's almost like indescribable. You're like, this just doesn't even make any sense. And I don't mind, you know, hopping on an evening video saying like, right now markets don't make sense. And I'll give you a prime kind of idea over here. If you look at something like the bonds, okay, from the beginning of the year, the bonds have been on a slight trend to the upside. Now, the bonds are one thing. We'll also take a look at the notes. Okay, the notes since the beginning of the year, and you can even come in here, you can contract, adjust the notes. Hey, listen, whatever does it for you, right? Adjust for contract changes, hit apply, hit okay. I think everybody would agree the trend in these notes, here's from the beginning of the year to right now, is steadily increasing, right? They started out the year, and this is the 10-year note. They started out the year, just north of this 123. Here they are at 126. Now, because we're seeing a bit of a rally in the bond market, the note market, what does that do, for instance, to interest rates? Okay, and here since the beginning of the year, interest rates are down. At the exact same time, what do you see in terms of financials? Financials right now are actually trading almost percentage-wise with the bonds, which is contrary to what you'd believe. Clearly, the Fed is having a little bit of influence. Okay, so maybe it's the Fed. You could point a finger there. Okay, maybe it's legislation, you know, is easing off in terms of the XLF. But then you start looking at the relationships, okay, that have existed like through and through. And, you know, you look at things like, you know, the EEM, okay? EEM exploding to the upside. This is also a very interest rate sensitive product over here. And again, why is EEM exploding to the upside? It's not, and it's breaking correlation with a lot of the interest rate plays that we've seen in the past. We could go on all day long. Everything that you see on your screen, okay, is in correlation flux. And if you're unfamiliar with this idea of correlation, allow me to display it, okay, in kind of like a chart form here. And this is a style I built quite a long time ago. And one of the styles that I often look at is just a comparison chart. You know, compare, contrast, if you will. But when you start talking about correlation, This is the Qs versus the IWM versus the spider. Okay, and I'll give you an exact idea of what this kind of correlation breakdown really means, especially when you start to zoom in, even like on a 3-month. I mean, if you missed it today, and I say everywhere you look, whether it's the bonds, whether it's the financials, what is going on today inside of the IWM? The Russell is tanking today, and I've got it obviously highlighted on the screen. The Russell tanks by 1%. At the exact same time, the NASDAQ rallies. What do the S&Ps do? Absolutely nothing. Again, through and through this correlation breakdown, there can be nothing healthy about a marketplace that is in this kind of sheer chaotic state over here. More often than not, when markets have tendency to normalize. And when I say when markets have tendency to normalize, let's actually go out to a much broader time frame. Okay, and we're going to look at the Qs versus the IWM versus the spiders. And when I say a larger time frame, initially bring up like 3 years. And you can see when things come back into correlation is typically in kind of wild sell-offs. And am I saying that the market's going to, have a wild sell-off necessarily tomorrow? Absolutely not. But in essence, to normalize what is incredibly broken correlation coefficients over here, we will need just that. Now I'm bringing up like a 5-year weekly. When I wanted to talk about, again, when you see things normalize, again, it's large dips in the market. And large dips in the market, there's number one, there's no place to hide. Okay. Number two, the correlations all move in lockstep. You'll see. Okay. And this is not really running true correlation coefficients. This is just a little bit of an eye test where you're looking like, well, over here we have the IWM and it looks to be moving the same as the spiders and the Qs. Okay. And you can see the NASDAQ outperforming over the last 5 years. You can even look on a 10-year monthly. You talk about correlation. Look no further than the financial crisis where every single product, they just moved in lockstep to the downside. And we've seen nothing but a divergence ultimately since. Okay. But now, again, we are seeing one product up, one product down, advanced decline lines as sloppy as can be. If you haven't looked at the Dow lately, what kind of chaos is going on in there? I'll tell you exactly what goes on in the Dow. Okay. The Dow has nothing to do with market cap weighting. The Dow has everything to do with a point move. So if Boeing, which Boeing moved up huge in the last, couple of weeks, if Boeing moves up huge, Apple moves up huge, okay, ultimately it's influencing the Dow. The Dow is pulling away, okay, from the rest of the index products out there. Meanwhile, the Russell, literally today, and I'll just bring up the Russell here on an intraday basis, the Russell took a big hit of 1% seemingly out of nowhere. People, keep an eye on this, okay? No one right now is expecting really any heavy amounts of volatility per se in markets. But again, this correlation breakdown, this does not end well. Last, okay, not least over here, we're going to take a quick glance at Tesla. Tesla comes out, of course, after the bell today. It's got about a $22 expected move on it. All right, we're expecting Tesla results literally any moment over here, up slightly. And I'm looking for the Tesla news, which is not out. And again, a little bit of a last note, of course, of Apple. We were looking for Apple to have a sharp sell-off, which it absolutely did today. Rallied back up a bit by the close, but we were just a hair off of being inside the expected move. So for the most part, I don't want to sit here and claim victory from last night's video, but it was Apple pulling back towards the expected move that really rocked the broader NASDAQ today. At the same time, you look at it and you're like, wait, the NASDAQ ended up 19. Wild range, again, in the NASDAQ of almost 100 points. What we want to look for in just the next couple of trading days, is this volatility in the NASDAQ going to, again, start to proliferate? Are we going to see some correlations come back into play? Thanks, everybody, for joining us at Theo Trade. Have a wonderful evening.